Every few months, the same headline appears. The stock market is in a bubble. Then a few weeks later, another headline appears. The market is about to crash. And somewhere in between those two predictions, the market continues doing what markets usually do, moving up, moving down, confusing everyone. So the real question is this: are we actually in a stock market bubble, or is this just another cycle? And more importantly, what should smart investors do about it? Welcome to the Simply Speaking About Money video channel. It is here where we talk about budgeting, saving, and investing in the real world of probabilities, and not the crazy hype, noise, and lottery-like promises of possibilities. Fear of bubbles is nothing new. Investors worried about bubbles in the tech boom, the housing boom, cryptocurrency, artificial intelligence stocks. Anytime markets rise significantly, the word bubble quickly appears. Sometimes the warnings are correct. Often they are not. A market bubble occurs when asset prices rise far beyond their underlying economic value. Prices increase rapidly. Speculation becomes widespread. Investors begin buying simply because they believe prices will continue rising. At that point, the market becomes driven more by emotion than fundamentals. At Simply Speaking About Money, we follow a simple approach: budget, save, invest. And when we invest, we focus on probabilities, not possibilities, because predicting bubbles perfectly is nearly impossible. But building wealth through disciplined investing is very achievable. Here's the uncomfortable truth: predicting bubbles in real time is extremely difficult. In fact, many investors have predicted dozens of bubbles that never happened, and investors who exit the market too early often miss years of growth. Interestingly, markets almost always feel risky. During bull markets, investors fear bubbles. During bear markets, investors fear collapse, which means there is almost never a moment when markets feel completely safe. And that's exactly why disciplined investors focus on long-term probabilities instead of short-term predictions. Before we go further, if you enjoy clear financial education without hype, subscribe to the channel. We focus on budgeting, saving, and long-term investing strategies that actually work over decades. No speculation, no dramatic predictions, just smart financial fundamentals. There are a few classic warning signs of bubbles: prices rising far faster than company earnings, extreme speculation, investors chasing trends without understanding the underlying business, and the belief that prices can only go up. History shows that when these conditions become extreme, markets eventually correct. However, corrections are not the same as catastrophic crashes. Markets naturally go through cycles: growth, correction, recovery. And over long periods, economic expansion has historically pushed markets higher. On the other side of the bubble conversation is the fear of a major market collapse, recession fears, interest rate increases, global economic uncertainty. All of these factors can create concerns about a major downturn. But here's something interesting. Markets have always faced uncertainty: wars, recessions, political changes, economic crises. Despite all of this, markets have historically recovered and continued growing over long periods. Investors often try to avoid bubbles by timing the market: selling before the crash, buying after the decline. Sounds great. Unfortunately, identifying the exact turning point is extremely difficult. Even professional investors rarely do it consistently. There's another problem with trying to time the market. Some of the biggest gains occur shortly after major declines. Investors who leave the market often miss these powerful recovery days, which can significantly reduce long-term returns. Instead of trying to predict bubbles, smart investors focus on strategy, diversification, consistent investing, long-term thinking. These strategies do not depend on perfectly predicting market cycles. Diversification spreads investments across different sectors and companies. Some industries will struggle, others will grow. A diversified portfolio allows investors to benefit from overall economic progress while reducing exposure to individual risks. Many disciplined investors use automation. Automatic investing continues regardless of market conditions. No panic selling, no emotional buying, just consistent investing over time. Automation helps investors avoid one of the biggest problems in investing: emotional decision-making. Compounding rewards investors who remain patient. Returns generate additional returns, and over long periods, growth accelerates. But compounding only works if investors stay invested through market cycles. Financial media often amplifies both bubble fears and crash predictions. Dramatic headlines attract attention, but long-term investors understand that most short-term predictions are unreliable. Markets are complex systems influenced by thousands of variables. So the real question isn't, are we in a bubble? Or is a crash coming tomorrow? The real question is, do you have a disciplined strategy that works regardless of short-term market movements? If you want more videos about long-term investing, probability-based strategies, and practical financial education, subscribe to the channel. We focus on simple principles that help people build real wealth over time. Because successful investing is rarely about perfect predictions, it's about consistent discipline. Smart investors don't panic during bubble warnings. They don't celebrate excessively during market rallies. They stay diversified, they stay invested, and they stay focused on long-term growth. History shows that markets go through cycles, but long-term investors who remain disciplined have historically benefited from economic growth and compounding. The key is patience. If you want to see your entire financial life in one place, clarity is the first step. That's where Empower comes in. Empower gives you powerful tools to track your net worth, monitor investments, analyze fees, and plan for retirement, all in one dashboard. You can connect your accounts, see exactly where you stand, and make smarter decisions with real data, because what gets measured gets managed. If you're serious about organizing your money and building long-term wealth, check out the link in the description to explore Empower. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you. If you found value in today's video, make sure you hit the like button and subscribe to Simply Speaking About Money, so you never miss practical strategies that help you build wealth and make smarter financial decisions. Also, check the description box below for the financial tool we recommend related to today's topic. It's a resource we personally suggest because it can help you apply what you've just learned and take action immediately. Your support helps this channel continue bringing you clear, no-hype financial education. Now stay with us, because up next is a special bonus that can help you take this even further.